There are several factors that affect the movement of bond funds: duration, credit quality, etc. But here's a fund where the manager is given flexibility on how to position itself when it comes to the duration as well as the securities. That is the dynamic bond fund category. That's what we'll be discussing today, and I have with me Deepak Agrawal, the Chief Investment Officer for Debt with Kotak Mahindra Asset Management Company Limited. Hi Deepak, let's start off by introducing this fund category to our viewers.
Dynamic category is one of the funds within the 16 categories of debt schemes which a mutual fund can launch. Dynamic scheme does not have a floor and cap on duration, so the fund manager can actively use duration and create alpha for investors based on his interest rate view. There is no specific sector allocation limits in place. The fund can either be invested 100% in sovereign or in state government securities, or the fund can also invest 100% of its portfolio in corporate bonds. The entire flexibility is given to the fund manager or portfolio manager to construct the portfolio, as well as flexibility is there on the duration front in order to create alpha for investors.
Now let's talk specifically about the Kotak Dynamic Bond Fund. What are the factors you consider, when it comes to duration or the kind of securities that you're adding during portfolio construction?
So let's say Kotak Dynamic Scheme now has completed close to 16 years. When the fund was launched, repo rate was close to 775. And during its cycle, the fund has seen global financial crisis of 2008, currency crisis of 2013, and the recent, let's say, credit crisis during the COVID period of 2020. During its life, the fund has also seen a higher repo rate of close to 9% and a lower repo rate of close to 4%, which we saw in 2020. Across the time frame, the duration of the fund has been managed actively. And at all points of time, 80% of the portfolio was either invested in sovereign or AAA assets on an average. And the fund has performed over the course of last 16 years. Just to give you an example, let's say in 2021, central bankers were cutting rates, the yield curve was quite steep. The fund intended to run a higher duration. Similarly, in calendar year 2023, when global central bankers were raising rates, the fund was maintaining a lower duration in the band of 2 to 3 years. And in this period, when we believe that the rate hiking cycle is over, plus given our good macro or strong macro of lower fiscal deficit and index flows, the fund has been maintaining a higher duration in the range of 7 to 9 years for last 3 to 6 months. So the way it has been managed over the course of last 16 years, we will continue to do so based on our macro assessment of the economy and based on the attractiveness of particular segment. And the maturities will also be selected based on our assessment of the segments being the best attractive portion across the yield curve.
And to wrap it up, what kind of investors should consider adding this fund in their portfolio?
So since the fund manager or portfolio manager is actively managing the duration, and he will basically, whenever, let's say, fields are trending higher, he'll be to his best judgment maintaining lower duration, and when interest rates are trending higher, he'll be maintaining higher duration and try to create alpha for investors. We believe investors with 1 year plus investment horizon can consider investing in a dynamic fund as part of their investment portfolio.
Thank you, Deepak, for that. Well, that was the introduction into the Dynamic Bond Fund category and the Kotak Dynamic Bond Fund. Log on to kotakmf.com to know more.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.